Before we begin, a brief word. If you value measured, disciplined analysis in a market that rewards patience over panic, consider subscribing to this channel. You'll find the red subscribe button below this video. We don't chase headlines, we study structure, we prepare, not predict. Now, let's discuss what's happening in silver markets and what it means for your capital. Silver just closed its strongest weekly performance in over 2 years. Not with fanfare, not with celebration from institutional desks, but quietly, methodically, week after week, the metal has been building a technical structure that most traders missed entirely. Why did they miss it? Because they were still nursing losses from the whipsaw that happened 6 months ago. They were still mentally trapped in the violence of that decline. They were waiting for one more drop to re-enter. That drop never came. This is how major moves begin, not with consensus, not with comfortable entry points, but with doubt, hesitation, and the quiet recalibration of market architecture while most participants remain sidelined. Today, we're going to examine what just happened in silver markets with the discipline this moment deserves. No hype, no price predictions, just structure, context, and strategy. Because if you don't understand why this move matters, you'll mismanage the next phase entirely. Silver has now printed record weekly closing highs, meaning the weekly candlestick pattern has confirmed strength at levels not seen since the previous major cycle peak. This isn't about intraday spikes or headline-driven volatility. This is structural change. Weekly closing highs matter because they represent sustained buying pressure that persists through the entire trading week. It's not algorithmic noise. It's not speculation bleeding out by Friday's close. It's accumulation. When precious metals print this kind of weekly confirmation after prolonged consolidation, the market is signaling a shift in underlying demand dynamics. Not a guarantee of continuation, but a probability structure that demands attention. The whipsaw that occurred 6 months ago, that was the test. Markets always test the resolve of new buyers before establishing a trend. They shake out weak hands. They create doubt precisely when the structure is turning. And most traders fail this test every single time. They buy the initial excitement. They panic during the sharp reversal. They sell near the lows, convinced the move was over. Then they sit in disbelief as the market quietly rebuilds and eventually exceeds the previous highs without them. This is not a flaw in their trading system. This is a flaw in their psychology. Let's talk about that whipsaw specifically, because understanding it is essential to managing the current phase correctly. 6 months ago, silver experienced a sharp rally that attracted retail attention. The move was fast, emotional, and accompanied by predictable social media euphoria. New traders piled in, leverage increased. Everyone expected immediate continuation to the next level. Then the market reversed violently. Within 2 weeks, nearly all of those gains evaporated. Stop losses were triggered, margin calls were issued. The narrative shifted from breakout to fake out overnight. But here's what most people don't understand. That reversal wasn't random. It was engineered by the natural rhythm of market cycles. Markets need to shake out speculative excess before they can build sustainable trends. The whipsaw wasn't a failure of the bullish thesis. It was the market's way of removing the participants who would sell too early anyway. Think about it logically. If everyone who bought the initial rally had stayed in, what would happen when the market reached the next resistance level? Mass profit taking, coordinated selling, structural weakness at precisely the wrong moment. The whipsaw solved that problem. It removed the weak hands. It created doubt in the minds of marginal buyers. It reset the sentiment from greed back to caution. And now, as silver prints new weekly highs, those same traders are still waiting, still doubting, still convinced it can't be real this time. That doubt? That's the fuel for the next phase. None of this is happening in a vacuum. Silver's movement is occurring against a macroeconomic backdrop that deserves careful examination. We're navigating a period of profound uncertainty in currency markets, sovereign debt dynamics, and central bank policy coordination. Real interest rates remain distorted by historic intervention. Central banks continue to hold balance sheets that dwarf pre-2008 levels. Government debt-to-GDP ratios across developed economies are at peacetime records. This isn't a crisis statement. This is simply the environment. And in this environment, hard assets with tangible industrial demand and monetary history begin to exhibit different behavior than they do in stable, low-debt economic periods. Silver sits at the intersection of multiple macroeconomic forces. It has industrial applications in electronics, solar panels, and emerging technologies. It has historical monetary significance. It has limited supply and inelastic production response. When currency confidence becomes even marginally questioned, when inflation expectations fluctuate, when geopolitical risk reduces trust in counterparties, silver becomes relevant again, not as a speculation, as a hedge. The recent move in silver isn't driven solely by technical patterns or trader positioning. It's supported by a quiet but persistent increase in physical demand from sources that don't typically appear in daily trading volume reports. Central banks and emerging markets. Industrial buyers securing long-term supply, institutional managers adding small but meaningful allocations to diversify away from pure financial assets. This is the kind of demand that doesn't show up in sentiment surveys. It doesn't announce itself on financial news networks. It simply accumulates week after week, creating the structural bid that allows technical breakouts to sustain. History doesn't repeat, but market structure rhymes with remarkable consistency. Silver has experienced several major cycles over the past 5 decades. Each cycle followed a similar pattern: extended consolidation, false breakouts that shook out weak hands, then sustained moves that exceeded most analysts' expectations. In 1979, silver consolidated for years around $5 or $6 per ounce. Then it exploded to $50, not because of technical patterns alone, but because macroeconomic conditions aligned with supply-demand imbalances at precisely the right moment. In 2003, silver traded around $4 to $5 per ounce. Most market participants had written off precious metals entirely after 2 decades of decline. Then, over the next 8 years, it rallied to nearly $50 again, driven by quantitative easing, currency debasement concerns, and emerging market demand. What's instructive about both cycles isn't the magnitude of the moves, it's the psychology that preceded them. Before each major rally, the dominant narrative was skepticism. Silver was obsolete. It was a relic. It had no practical use in modern portfolios. Then quietly, systematically, the price structure changed, not with headlines, but with weekly closes that kept inching higher despite persistent doubt from mainstream analysts. The traders who profited weren't the ones who predicted the tops. They were the ones who recognized the structural shift early, positioned appropriately, and managed their risk throughout the move. The traders who failed weren't less intelligent. They were simply trapped by the need for certainty before acting. They waited for confirmation that was too obvious. They entered when the move was mature, when risk-reward had already deteriorated. We're studying history not to predict the future, but to understand the behavioral patterns that create opportunity and the psychological traps that create loss. Let's talk about the mental state of various market participants right now. The retail trader who sold during the whipsaw is experiencing regret. They're watching current prices exceed their exit point. They're calculating the profit they should have had. They're debating whether to chase the move now or wait for another pullback. This mental state is dangerous because it prioritizes emotion over structure. The professional money manager who dismissed silver 6 months ago is now facing a different problem. If silver continues higher, they'll need to explain to clients why they had no exposure to an asset class that's outperforming. This creates pressure to establish a position, even at less favorable levels. The institutional buyer who accumulated during the consolidation is feeling vindicated, but facing a new challenge: when to take profits, when to add, and how to manage a position that's now showing significant unrealized gains. Each of these psychological states leads to predictable errors. The regretful trader often re-enters at exactly the wrong moment, buying strength near short-term exhaustion points, then panicking again on the next normal pullback. They turn a structural trend into a series of mistimed trades that destroy capital. The pressured manager enters with insufficient conviction, sizing the position too small to matter if correct, but large enough to cause panic if wrong. They end up cutting at the worst possible time, adding nothing to client returns while taking all the emotional volatility. The vindicated accumulator often exits too early, banking gains that feel satisfying, but abandoning the position before the major move has fully developed. They confuse being right with maximizing the opportunity. Understanding these psychological patterns isn't about judging others. It's about recognizing these same impulses in ourselves and building a framework to operate more effectively. Because here's the truth: every trader experiences doubt, regret, impatience, and fear. The difference between success and failure isn't the absence of these emotions. It's the presence of a process that functions despite them. If you currently hold silver, either physically or through properly structured vehicles, you're facing a specific set of decisions. First, understand your original thesis. Why did you establish this position? Was it a trade, a hedge, a long-term allocation? This distinction matters enormously because it determines appropriate action now. If this was a trade with a defined risk-reward structure, you should already have exit parameters in place. If you don't, you're gambling, not trading. Define them now based on technical levels, time horizons, or percentage targets that align with your capital management rules. If this was a hedge against currency debasement or systemic risk, current price appreciation doesn't change the fundamental reason for holding. In fact, the fact that silver is rallying might indicate the risks you were hedging against are being priced in by other market participants. That's confirmation, not a sell signal. If this was a long-term allocation based on supply-demand fundamentals and macro positioning, you need to evaluate whether anything has changed in that structural analysis. Has industrial demand shifted? Has supply dramatically increased? Have the monetary conditions that supported your thesis reversed? If the answers are no, then short-term price movement is noise, not a signal. Here's what current holders should not do. Make decisions based on how this position feels right now. It feels good to see unrealized gains. It feels validating to be right after enduring the whipsaw months ago. But feelings are not strategy. The most dangerous moment for any position is when it becomes emotionally comfortable, because that's when discipline erodes. That's when you stop following your risk management rules. That's when you extrapolate current momentum infinitely into the future. Consider implementing a structured approach to managing winning positions. This might involve scaling out partial positions at predetermined technical levels while maintaining core exposure. It might involve tightening stop-loss parameters to protect gains while allowing for continued upside. It might involve doing nothing at all if your thesis remains intact and your position sizing was appropriate from the beginning. What matters is conscious decision-making based on analysis, not reaction based on emotion. One practical framework. Divide your position into tranches with different management rules. Core position. Manage based on fundamental thesis and only exited if thesis is invalidated. Trading position. Manage based on technical structure. Exited at resistance levels or momentum exhaustion signals. Opportunistic position. Managed aggressively, used to capture short-term volatility without affecting core exposure. This allows you to satisfy different objectives simultaneously without the paralysis of trying to perfectly time one large position. Remember, the goal isn't to capture every dollar of every move. The goal is to compound capital over time by managing positions with discipline through various market conditions. If you don't currently have exposure to silver and you're evaluating whether to establish a position now, you face a different set of questions. The worst question you can ask is this the top? Nobody knows. Not me. Not the analysts on financial television. Not the most sophisticated algorithms in quantitative hedge funds. Market tops are only obvious in retrospect. Asking, is this the top? Is asking for certainty that doesn't exist and can never exist in financial markets. The better question is, does the risk-reward structure justify establishing exposure at current levels? This question can actually be analyzed. Look at the technical structure. Silver is broken out of consolidation, confirmed with strong weekly closes, but hasn't yet reached the kind of parabolic extension that characterizes final euphoric moves. The structure suggests continuation is more probable than immediate reversal, but probability is not certainty. Look at positioning data if you have access. Are futures markets showing extreme speculation? Is open interest spiking to unsustainable levels? Are retail search trends and social media mentions reaching the kind of fever pitch that marks emotional exhaustion? If yes, be cautious regardless of price action. If no, the move likely has room to develop. Look at the macroeconomic context. Are the conditions that typically support silver price appreciation still present? Currency uncertainty? Inflation concerns? Supply constraints? Demand growth? If these factors remain in place, a position might be justified even after a strong move because the structural drivers haven't been exhausted. Now, let's talk about how not to enter. Don't chase with full position size on a green candle day. This is how retail traders consistently lose money. They watch the move from the sidelines, experience mounting FOMO as prices rise, then finally capitulate and buy on a strong up day, often near short-term resistance. Then they panic on the first pullback. Instead, consider a scaling approach. Establish a small initial position at current levels if you believe the structural thesis is sound. This accomplishes two things. It gives you skin in the game, which improves your attention and analysis, and it removes the psychological burden of missing the entire move. Then plan subsequent entries at specific technical levels, perhaps on a pullback to previous resistance turned support, perhaps on a consolidation pattern that develops over coming weeks, perhaps on a breakout above the next major resistance level if momentum confirms. This approach isn't perfect. You might not establish full exposure before the move accelerates, but you also won't destroy your capital by buying at a local peak and panicking out at the first normal retracement. For those considering physical silver versus paper exposure, understand the distinction clearly. Physical silver provides tangible ownership without counterparty risk, but comes with storage costs, illiquidity, and wider bid-ask spreads. It's appropriate for long-term holdings and crisis hedging. Paper silver, through properly structured ETFs or futures, provides liquidity, tight spreads, and ease of management, but introduces counterparty risk and doesn't provide the same crisis hedge properties. Match the vehicle to your actual objective. Don't buy physical silver if you're planning to trade around short-term price moves. Don't buy paper exposure if your real concern is systemic financial risk. Most importantly, size your position appropriately within your overall portfolio context. If silver goes to zero, would your financial life be destroyed? If yes, your position too large. If silver doubles and your net worth barely changes, were you positioned too small to justify the time and energy spent analyzing the opportunity? Perhaps. Position sizing is the most underrated skill in investing. Perfect analysis, combined with inappropriate position sizing, produces mediocre results. Reasonable analysis combined with proper position sizing produces sustainable long-term wealth. Let's be direct about the behavioral errors that destroy capital during moves like this. Watching the screen every hour, feeling elation when prices rise, panic when they dip, and making decisions based on these emotional states rather than your predefined strategy. This is how positions that should be winners become losers. You trade yourself out of good positions because you can't tolerate normal volatility. Using margin, options leverage, or futures contracts to amplify exposure beyond your risk tolerance. Leverage magnifies gains, yes, but it also magnifies losses and eliminates your ability to endure drawdowns. One normal pullback can wipe out a leveraged position that would have been profitable if held with appropriate sizing. Every market participant believes their current thesis is special, unique, and immune to the normal rules of risk management. It never is. Stop losses, position limits, and portfolio diversification remain essential regardless of how confident you feel. Silver markets generate endless narratives: supply shortages, manipulation theories, central bank conspiracies. Most of this noise is irrelevant to actual price structure. Trading based on headlines rather than analysis creates whipsaw losses and missed opportunities. You can be completely correct that silver is in a major uptrend and still lose money by entering at poor levels, sizing inappropriately, or exiting prematurely out of fear. Directional accuracy is only one component of successful investing. Becoming so focused on silver's performance that you neglect other positions, fail to rebalance, or allow one position to dominate your portfolio risk. Concentration creates spectacular returns when correct and spectacular losses when wrong. All trends end. All bull markets become bear markets. All periods of strength experience corrections. Planning only for continued upside while ignoring the eventual reversal is guaranteed failure. Constantly checking what other traders are doing, what analysts are saying, what social media sentiment indicates. This external focus prevents you from following your own well-considered strategy and makes you vulnerable to groupthink at extremes, trying to make up for a small position by trading more aggressively. This leads to overtrading, excessive risk-taking, and ultimately worse results than simply accepting the original position size and managing it properly. Is success a 20% gain, a 3-year hold, protection against a specific risk? Without defining what you're actually trying to accomplish, you'll never know when to exit, adjust, or simply hold, leading to indecision at critical moments. Avoiding these mistakes won't guarantee profits. Markets are uncertain and losses are part of the process. But avoiding these mistakes will prevent the self-inflicted wounds that account for most trader failures. We need to address a topic that appears constantly in precious metals discussion: market manipulation. Many silver investors believe the market is systematically suppressed by large banks, governments, or coordinated interests. They view price action through this lens exclusively, interpreting every decline as manipulation and every rally as the manipulation ending. This narrative is dangerous for 2 reasons. First, it removes your agency. If you believe markets are entirely controlled by unseen forces, why would your analysis matter? Why would strategy matter? You're reduced to hoping the manipulators allow prices to rise, which is not an investment thesis. Second, it prevents you from learning. Every unexpected move becomes explained by manipulation rather than recognized as a gap in your understanding of market structure, positioning, or dynamics. You never improve as a trader because you never acknowledge mistakes. Here's a more productive perspective. Are precious metals markets influenced by large institutional players with more resources and information than retail traders? Absolutely. This is true of every liquid market in existence. Do regulators sometimes uncover specific instances of spoofing, layering, or other illegal practices? Yes, and those institutions are fined. But the day-to-day price action you see is primarily driven by the same forces that drive all markets: supply and demand, positioning, sentiment, and macroeconomic conditions. Focusing on manipulation prevents you from studying these actual dynamics. It's a form of intellectual surrender disguised as sophisticated awareness. Trade and invest based on what you can observe, measure, and analyze, not based on invisible forces you can neither prove nor use productively in your decision-making. One certainty about silver markets: volatility will increase from here. Whether prices continue higher, reverse sharply, or consolidate before the next move, the realized volatility, the actual day-to-day price swings, will expand. This is standard behavior when metals break out of consolidation. Higher volatility creates both opportunity and danger. For disciplined traders with appropriate position sizing and risk management, volatility is profitable. It creates entry points during pullbacks and exit points during rallies. It allows you to add to positions when structure improves and reduce when structure deteriorates. For undisciplined traders or those positioned too large, volatility is destructive. It triggers emotional decision-making. It creates margin pressure. It leads to buying high and selling low repeatedly. Prepare mentally for larger daily moves now. A 3 to 5% daily swing in silver prices, which would have been unusual during the consolidation period, may become routine during a sustained trend. This doesn't mean the trend is failing. It means the trend is actively developing. If you can't emotionally tolerate 5% daily swings in your silver position, you're positioned too large. Reduce size until volatility becomes manageable within your psychological framework. There's no shame in this adjustment. In fact, it's one of the most sophisticated things you can do. Recognizing your actual risk tolerance and positioning accordingly demonstrates self-awareness that most traders lack. Let's elevate the conversation beyond silver specifically. What's happening in silver markets is a case study in how major market moves develop across all asset classes. Understanding this process improves your ability to recognize opportunity and manage risk everywhere. Most significant price trends begin the same way: extended consolidation, false breakout that shakes out weak hands, quiet accumulation, then confirmed breakout that most participants miss because they're still psychologically trapped in the previous failure. This pattern repeats in stocks, commodities, currencies, and real estate. It's not specific to silver. It's the natural rhythm of market cycles driven by human psychology. Why does it matter that you understand this? Because the next major opportunity you encounter, whether in silver or any other market, will likely follow the same pattern. And if you've learned to recognize the structure, you'll have an enormous advantage over those who remain trapped in emotional reaction. The traders who consistently profit over decades aren't smarter. They're not better at predicting. They simply recognize structural patterns earlier and manage positions more effectively through the development of those patterns. This is a learnable skill. Not easy, but learnable. Silver's current move is providing you with a live case study. Whether you profit from this specific opportunity or not, the lessons you extract will serve you for years across multiple markets and countless opportunities. That's the real value, not the profit from one position, but the development of a framework that works repeatedly. A critical point that often gets lost in focused analysis of one asset. Portfolio context matters more than individual position performance. You should never evaluate silver in isolation. It exists as one component of a broader portfolio designed to achieve specific objectives across various economic environments. In an ideal portfolio structure, silver serves multiple purposes simultaneously. It provides inflation protection during periods of currency debasement. It offers crisis hedging during periods of systemic financial stress. It generates returns during commodity bull cycles. It diversifies away from pure financial assets with counterparty risk. But it also introduces volatility, provides no yield, and can experience extended periods of negative performance. This means silver's appropriate allocation varies dramatically based on your specific situation. A retiree living on fixed income with low risk tolerance and need for stability might hold 2 or 5% in precious metals as insurance, never trading it, viewing it as protection rather than performance. A younger accumulator with decades until retirement and high risk tolerance might hold 10 to over 15%, actively managing the position to capture cyclical trends while maintaining core exposure. A professional trader with sophisticated risk management and short time horizons might use silver purely tactically, holding zero exposure most of the time and significant positions only when technical and macro conditions align. None of these approaches is universally correct. They're all appropriate for different contexts. The mistake is copying someone else's allocation without understanding whether it fits your actual situation. If you're uncomfortable during this volatility, you likely have too much exposure. If you're unconcerned whether silver doubles or halves, you likely have too little exposure to justify the time spent analyzing it. Right-sizing your allocation. Relative to both your financial objectives and psychological tolerance is more important than perfectly timing entries and exits. Step back from daily price action for a moment and consider the multi-decade context. Silver, like all hard assets with limited supply and real demand, tends to preserve purchasing power over very long time horizons. This doesn't mean it goes up every year. It means that over decades, it maintains value relative to the expansion of monetary supply. A retiree today who held silver 50 years ago can purchase approximately the same basket of goods, despite thousands of % increase in nominal monetary supply. That's the function of hard assets in a portfolio. But that long-term preservation of value came with extraordinary volatility along the way. There were decades of decline. There were years of spectacular gains. There were periods when silver seemed completely irrelevant to modern markets. Through all of that, it served its function, maintaining optionality, providing crisis insurance, and occasionally participating in environments where financial assets struggled. This long-term perspective doesn't help you trade the current move, but it does help you maintain discipline during the inevitable periods when positions move against you. If you understand you're holding silver as long-term purchasing power protection, a 20% drawdown doesn't trigger panic. It's noise within the broader function. If you understand you're holding silver as crisis insurance, it can sit dormant for years without concern. Its purpose isn't daily performance, it's specific environment performance. But if you're holding silver as a trade without defined parameters, every move creates anxiety because you lack the framework to evaluate whether the position is performing its function. Define the function, then manage toward that function, not toward daily price action. Let's conclude with concrete steps you can take immediately to position yourself appropriately for whatever develops next. Write down exactly what you own, why you own it when you bought it, and what would need to happen for you to sell it. If you can't answer these questions clearly, you don't have a position. You have a hope. Determine the maximum loss you can tolerate on this position without it affecting your broader financial life. Set stops, mental or actual, that enforce this limit. This isn't pessimism, it's professionalism. Where are the support levels that would indicate the structure is failing? Where are the resistance levels where profit taking is likely? Mark these on a chart and plan your behavior at each level before you reach them. Decide to evaluate this position weekly or monthly, not hourly. Continuous monitoring creates emotional decision-making. Periodic review allows you to assess structure without drowning in noise. If you only consume information that confirms your existing position, you're not analyzing, you're seeking validation. Actively seek perspectives that challenge your thesis to ensure you're not missing critical information. Rebalance if silver has become an outsized percentage of your net worth due to appreciation. Concentration creates risk that overwhelms any potential additional return. Keep a journal of why you make each significant decision regarding this position. This creates accountability and allows you to learn from both successes and failures over time. Have a plan for continued rally. Have a plan for sharp reversal. Have a plan for extended consolidation. You won't know which scenario unfolds, but you can be prepared for all of them. We've covered significant ground together: technical structure, macroeconomic context, historical patterns, investor psychology, risk management, strategy for different participant types. But all of this analysis is worthless without one element: discipline. Discipline to follow your plan when emotions scream otherwise. Discipline to take profits when targets are hit, even if momentum suggests more. Discipline to cut losses when stops are triggered, even if you believe the position will recover. Discipline to do nothing when no clear opportunity exists. Discipline to act decisively when opportunity presents itself. Discipline to learn from mistakes without letting them paralyze future decision-making. The markets don't care about your analysis. They don't reward intelligence. They reward discipline applied consistently over time. Silver is now printing record weekly highs after a violent whipsaw that removed weak hands and created doubt. This is classic structure for the beginning of sustained moves. But beginning doesn't mean guaranteed continuation. It means probability has shifted in favor of higher prices, creating opportunity for those positioned appropriately with proper risk management. Whether you profit from this specific opportunity depends entirely on whether you can execute with discipline. Can you size positions appropriately for your risk tolerance? Can you manage emotion when volatility increases? Can you follow your plan even when price action tempts you to abandon it? These questions determine your success far more than whether silver reaches any particular price level. The whiplash was the trap. It removed the participants who would have sold too early anyway. It created the doubt that fuels sustainable moves. It established the technical structure that defines opportunity. But recognizing the trap isn't enough. You must act on that recognition with appropriate caution, proper sizing, clear risk parameters, and unwavering discipline. The market is providing information, structure is developing, opportunity exists for those prepared to engage with it professionally. What you do next reveals whether you're a trader or simply someone who reacts to prices. Choose discipline. Choose process. Choose long-term compound growth over short-term emotional satisfaction. That's how wealth is built, not through perfect prediction, not through luck, but through systematic application of sound principles across thousands of decisions over many years. Silver is one opportunity among many you'll face. Master the approach now, and you'll profit from countless opportunities ahead. Stay disciplined, stay focused, and remember, the goal isn't to get rich from one position. The goal is to still be here, growing capital years from now when the next major opportunity presents itself. Thank you for your attention. If this analysis provided value, remember to subscribe using the red button below for continued disciplined financial insights. Now go review your positions, define your parameters, and prepare to execute your strategy with the professionalism this moment deserves.